If you've been watching the Melbourne property market over the last couple of years, it probably feels broken. Prices have risen in all of the other capital cities, whilst Melbourne has just lagged behind. Investor activity has dropped, media coverage has been relentlessly negative, and almost every conversation about Melbourne property seems to end with some version of it's uninvestable. But here's what makes this period genuinely confusing. As we head into December, the data underneath this narrative doesn't actually look broken. Rental markets are still tight, population is still rising, and some parts of Melbourne are already growing again. And that mismatch is what's unsettling a lot of people. Because markets feel easy when everything moves nicely together, when prices, rents, sentiment, and headlines all align. Confidence is very simple, but Melbourne isn't doing that right now. It's moving unevenly, but even uneven markets feel like they're malfunctioning even when they aren't. Guys, by the end of this video, you'll understand why Melbourne's sentiment is so negative, why this cycle feels unfamiliar, why Melbourne has quietly become a two-speed market, and why this actually creates opportunity for buyers who are selective and data-driven rather than dangerous. And you want to stay right until the very end, because I'm going to touch on how this investor withdrawal has created a two-speed market that has a number of opportunities hidden right underneath the surface. Guys, my name's Josh. I'm from DataEdge Property, and I help everyday Australians navigate the Australian property market using data that's accessible to absolutely everyone. And if you get value out of today's video, make sure you hit the like button and subscribe so you can continue receiving data-driven updates just like this. And with that said, let's dive straight into why Melbourne's sentiment is uniquely negative. You see, Melbourne's sentiment problem, it isn't all coming from one place. It's actually layered. And the first layer is narrative. For years now, Melbourne has been framed less as a housing market and more as a policy story. You've had land tax changes, regulation, investor exits, and those themes dominated coverage here in a way that they don't in most other states. The second layer is performance fatigue. Melbourne has underperformed relative to Sydney, Brisbane, Perth, and Adelaide for long enough now that investors stop giving it the benefit of the doubt. And when capital sees easier momentum elsewhere, it doesn't wait around for long. And you can see why holding onto property in Melbourne feels harder when you drill deeper into the numbers. If we look at the latest yield data out from SQM Research, it shows that gross rental yields for houses in Melbourne are now hovering in the low 3% range. And in a higher rate environment, that is an incredibly thin buffer. And even if the long-term fundamentals in Melbourne are improving, the short-term experience, it still feels uncomfortable for most investors. And the third layer is uncertainty. Even when policy changes are incremental, repeated tweaks, they change behavior. Investors don't need rules to be bad. They just need them to feel unstable. And here's the critical point. Sentiment doesn't need to be right to be powerful. When enough buyers believe that a market is done, activity slows, listings sit longer, and prices grind, even if the structural forces underneath haven't gone away. And this is exactly why the next data set that I'm about to talk about matters so much, because it tells us whether Melbourne demand has actually gone away or whether it's just being expressed very differently. You see, one of the most misunderstood parts of the Melbourne story right now is population growth. If we look at the most recent ABS data, it shows that Victoria's population grew by roughly 124,000 people, or about 1.8% in the year to June 2025. And if we look at this second chart here, it shows that most of that growth came from net overseas migration, which contributed around 92,000 people to that population growth story. And that matters because population growth, it doesn't disappear just because sentiment does. people still need somewhere to live. Now, here's where the story gets really interesting. When you compare that demand with housing supply, you don't see a city that's flooding itself with new stock. High build costs combined with weak feasibilities are constraining new construction, particularly in the areas that people actually want to live. But you see, that mismatch, it doesn't show up immediately in price growth right away, especially when buyers are cautious. Instead, it shows up somewhere else first, in rents. And if we have a look at SQM's December data, it has Melbourne's house rents sitting at around $770 per week, which has grown by about 24% in the last 3 years alone. And that tells you that demand hasn't evaporated. It's simply shifted away from buying and into renting. And when demand shifts like that, it doesn't disappear. It builds pressure quietly. But guys, before we move on, if you're serious about using data to build real wealth through property, don't just watch from the sidelines. Make sure you join my completely free DataEdge Property Community on Facebook. I share suburb level breakdowns and charts there before they ever hit YouTube. And with that said, let's discuss rental stress in Melbourne, as that tells us a completely different story. You see, if Melbourne were genuinely broken, you'd expect the rental data to reflect that clearly. But December's numbers, they don't support that view. If we look at this chart, SQM's latest vacancy data has Melbourne sitting at around 2% citywide, with just over 10,000 dwellings available. And that's definitely not oversupplied. That's a relatively tight, functioning rental market, noting that typically a balanced market, we would see a vacancy rate of around 3%. At the same time, advertised rents are higher than they were same time last year. So although growth has cooled compared to 2023, the direction hasn't reversed. And this matters because rental markets are where the demand often shows up first when confidence is weak. You see, when buying slows, renting absorbs that pressure, vacancies stay tight as a result, and price growth becomes selective rather than absent. And that selectivity is the clue that most people are missing, because Melbourne isn't falling evenly, it's just diverging. But guys, here's a quick question for you. Do you think that Melbourne's weakness is structural and permanent, or do you just think that it's cyclical and temporary? Make sure you drop your thoughts in the comment section down below. And now let's touch on the last reason why Melbourne feels broken, and that's investor withdrawal. You see, investor sentiment has definitely pulled back, and some of that is tax driven, whilst other parts of it are sentiment driven. And some of it is simply capital chasing markets with clearer narratives. And in the short term, that reduces competition, it slows price growth, and it makes selling feel much harder. And you can see this in SQM's asking price data, where Melbourne's asking prices are still higher than they were a year ago by about 6 to 7%. But that growth has been very uneven. It's happening in some pockets and not others. If you have a look at Cotality's mapping the market data, it actually puts some structure around this. Melbourne has become a clear two-speed market, where you have established owner-occupier-led housing markets already moving again. Meanwhile, investor-heavy stock and lower quality supply is lagging behind. And that's why sentiment feels so confusing right now, because people are asking whether Melbourne is back when the data says that parts of Melbourne never really left. And this is exactly where the opportunity starts to form. Two-speed markets, they don't reward broad exposure. They reward selectivity. They reward buyers who understand where demand is sticking and not just where prices are rising on average. And guys, if you want the broader macro context around why markets actually behave like this, make sure you watch my video on why the rate cut narrative broke and what that really means for Melbourne's property market heading into 2026. It's linked on screen and in the description box down below. Make sure you check it out right after this video. Well guys, with all of that said, one of the biggest mistakes I'm seeing people make right now is they assume that this cycle will look just like the last one. Indeed, between 2017 and 2019, Melbourne had a tightening credit falling prices, and negative sentiment. But supply pipelines were stronger and vacancy rates were materially higher. Today, vacancy rates are incredibly tight. Rental demand is still being absorbed, new construction is constrained, and population growth is running again. And whilst that doesn't guarantee a boom, it does mean that this isn't a market that's rolling over under excess supply. What it creates instead is a slower but more selective cycle. Less boom, less bust, more grind, and more reward for buyers who are prepared to do the work and remain patient. And that's exactly why Melbourne feels broken. Not because it's failing, but because it's transitioning. Indeed, Melbourne isn't broken, it's just selective. And guys, remember, I'm not your advisor. I can't guarantee how the next 12 months will actually play out. I'm just someone who spends a lot of time digging through property data, trying to separate signals from noise. And if this helped you see Melbourne more clearly, not emotionally, but structurally, well, I've done my job. Guys, I really appreciate you staying right until the very end of the video. If you got value out of it, make sure you hit the like button, subscribe, and I'll see you in the next one.